So, good afternoon, everyone, to the webinar Credit Where Credit's Due, EDF's Energy Transition Plan Analysis. Before I get started, I'd like to very quickly introduce Carbon Tracker, and then I'm going to introduce our presenter. And the session will last for about 45 to 50 minutes. You will be able to ask questions in the panel. Please do remember to put your names down so we know who's asked the questions. That'd be very, very helpful. And it means also if need be, we can get back to you individually. So Carbon Tracker is an independent not-for-profit research house that converts climate science into financial risk and reward. Our mission is to see an energy system that is sustainable within close proximity to 1.5 degrees warming scenario. This research, as well as our research, is all free to download from our website. So please visit carbontracker.org, as well as you can access this research through the usual third-party platforms. That's Bloomberg, FactSet, Thomson Reuters, and Capital IQ. So let me move straight on to introducing our analyst who created this research and also will present. So today I'm joined by Chris Moore, Senior Corporate Research Analyst for Europe. Very briefly, you can get Chris's profile on our website, but I do want to highlight a couple of things that I think is important. Chris joined us from BES, where he advised the Her Majesty's government on corporate finance. And prior to that, Chris was a supervisory analyst, director at Fitch Ratings, and responsible for European, UK power, gas, water, and waste debt issuers. Chris has also spent 25 years of his experience as an equity analyst specializing in European power, gas, and utilities. So I think you're going to be really enriched by his work today. To move on, I think I'm going to invite Chris now to start his presentation, please.
Thanks, Christopher, for those kind words. I hope you can hear me. I hope this presentation is live. I'll just move on to the first slide. This is a presentation which takes a short look at the leading nuclear name in the CA 100+ group, EDF. We wanted to have some peers with EDF, but EDF is fairly peerless. And we published fairly recently on the CA 100+ gas names, Centrica, Engie, and Naturgy back in February. EDF is a major debt and bond issuer, and its market presence makes it an obvious peer for pretty much anybody of the leading industry players in Europe. We look at the credit implications of realizing EDF's nuclear ambitions, and also its progress in aligning with the goals of the Paris Agreement. And the agenda you see here is really talking about what should be a nuclear low carbon hero and how they're getting on with Paris and the Paris alignment. But also we look at other issues, particularly the risk of stranded assets, especially in the gas business. We look at the capex profile with nuclear really very dominant. We ask if how EDF can fund all of the various competing calls on its cash flow, and lastly review how EDF is doing with Paris alignment and the credit risk. As you can see on the left-hand slide here, nuclear really does dominate the French fuel mix. And in fact, the slide here actually understates the weight of nuclear because of the stress corrosion issues that EDF is still going through at the moment. In fact, if you take those numbers to yesterday, nuclear was 76% of the fuel mix in France. On the table right, you see EDF's progress in reducing CO2 emissions since 2019, and those current targets that you see highlighted in yellow date from December 2020. So they're clearly out of date now, and I think that the CEO is due to review the operational and financial plan in June, and we will probably get, I would expect, some updated targets for 23 and 2030. So EDF has done pretty well so far, but clearly there's more to do. I think the other point here, which you don't see, is the carbon intensity in Q1 23, which was released last week. That's 46 grams of CO2 equivalent per kilowatt hour. That's pretty good by industry standards, but there is an issue with scope 3, as you can see here. It's about 80% of total emissions of CO2 for EDF, and in particular with gas. And I think this is a much bigger challenge for EDF than simply looking at the nuclear fleet. One other interesting thing we looked at here, I think, is that the flip side of a low carbon footprint is actually quite a high water footprint. EDF uses 0.83 liters per kilowatt hour to generate its electricity. That's pretty high. If you look at someone like NL, which obviously is a similar size capacity, that's about a quarter of that number. So there's a flip side to this low carbon footprint. So looking onto the gas now and scope 3, we estimate that gas probably contributes about 50% of EDF's total CO2 emissions. That's mainly from generation and heat production, but also in the sale of gas to around 6 million end customers, businesses and local authorities. The French supply and heating and cooling businesses account for another 40%. As you can see in the slide, Italy is by far the biggest source of those emissions. Additionally, EDF Trading is a big player, one of the biggest players in the European wholesale gas market, with annual volumes around 600 BCM. And we think that probably gas trading was a major source of EBITDA last year. Well, that's probably unsustainable. I would guess that normal fossil fuel EBITDA is about 15% of total. And you can see here on the slide some of EDF's plans to try to decarbonize gas. Edison in Italy is looking at doubling its renewables capacity, but also building 10 biogas and biomethane plants by 2030. But I think there's still a lot more work to do here. And this is, if you like, the flip side of the nuclear story. And looking at this in a bit more detail now, and just the picture on the left there is an artist's impression of the Marghera Levante CCGT, which is being refurbished this year near Venice. If you take the view that gas assets, particularly CCGT plants, only have a useful life of 30 years, as we would, then we would argue that the substantial additions that EDF is making now to CCGT capacity, particularly in Europe, are going to raise potentially significant asset stranding issues going forward. In fact, we think that probably EDF should start thinking about already retiring a gigawatt of capacity in Italy by 2028, because by then that will already be 30 years old. I'll talk about new nuclear in a minute and the stranding risk there, but that's a much harder call to make because the time frame is obviously a lot longer. But I think the key point is that EDF is somewhat behind, I think, in respect of some of its peers. Its coal exit as well is 2030, some way behind companies like ENGIE and some of the other players in the industry. One point more to highlight here is the renewables capex, which is also behind peers. EDF's current build rate suggests that the current target is fairly modest. And again, I'll talk about that in a bit more detail in a minute. So looking at the capex issue in nuclear specifically, on the slide on the left there, you can see this comes from EDF directly, the 2022 accounts, the breakdown of capex. If you add up nuclear maintenance, Framatome, Flamanville 3 and new nuclear, you're already at 50% of capex of the group. A key point here is that most of the nuclear maintenance capex and distribution capex is mandatory. So EDF doesn't have very much flexibility over capex in the other businesses. And the others you see at the bottom there, that's mainly CCGT fleet maintenance and development capex. So again, we're back to fossil fuels. The regulated distribution is another significant part of capex we've talked about. it doesn't leave very much room for renewables at just 15% of total. And I think as time goes on, obviously, renewables capex is getting a bigger ask now because of capex inflation, but also there are higher IRR hurdle rates now. So EDF has a lot of work cut out in terms of potentially raising renewables capex. So how does EDF fund everything? Well, I've got some numbers here on the state of the balance sheet on the right-hand side. If you look at their refinancing schedule, that's fairly heavy as well this year. And in particular, EDF hasn't generated free cash since 2009. And if you look at recurring cash EBITDA, which was around 16 billion euros last year, 17 billion euros last year, it barely covers capex at the moment. And so in many ways, I think that the biggest challenge facing EDF is maintaining the existing nuclear fleet in France, given where we are with the relatively low or lower level of power prices than we were even only a year ago. If we think also that debt costs are starting to increase by probably around 300 basis points over the last 18 months, and looking at the nuclear fleet at the moment, the stress corrosion issues have not been fully addressed yet, and therefore I suspect there's still some cash flow issues with the fleet, and that is the biggest source of EBITDA within the group. And if we look at what's been reported this year in France, I think that Q1 output was down by 7.4%. And what that would suggest is that in order to hit EDF's targets for the rest of the year, or mid-range target, we would need to see a recovery around 23% for nuclear output in France for the rest of this year. So that's quite a big ask. Final point on nuclear at the moment, anyway, is on new nuclear and the cost of that. I think it's fair to say that the new nuclear time frame and the cost may well increase, if only because of what we've seen recently at Flamanville 3 and at Hinkley Point. So that number of 52 billion is probably going to go higher as time goes on, and clearly that still doesn't leave any room for any further renewables. So how does EDF align with Paris? Well, I think that it will update its emission targets in June, and I think that on scope 1, it probably will achieve Paris achievement by 2030. I think that in terms of scope 3, that's a much bigger challenge, as we've said. A neat solution would be to sell Edison, which, as we've seen, is a fairly big source of group emissions. But of course, that doesn't help necessarily the environment. It's only a solution for the company, not for the planet. As I mentioned earlier, I think that EDF needs the existing nuclear fleet to be cash flow positive, and that's another big ask because the power price is incredibly volatile. If you look at where it has been in the first quarter of this year and the first quarter of last year, it's about 100 euro per megawatt hour lower. And I think that it's interesting that ENGIE, one of EDF's peer companies, has recently deconsolidated its Belgian nuclear because it wants to mitigate the merchant price volatility that nuclear gives. I think also, if we think about renewables, a potential solution here might be to look at, once again, spinning off the renewable business and looking for separate standalone funding. And RWE was asked about this very option on a conference call fairly recently. And I think that now that EDF has been in the process of being nationalized, the absence of minority shareholders is probably going to limit EDF's equity options. So it makes it more dependent on debt markets. And on that point, I think that in terms of the new nuclear bill, which is covered quite a lot in the press, it's hard to see, I think, how that can be funded until we stabilize the balance sheet with the existing business. And if we think about the debt structure at the moment, nearly 20% of EDF's debt, about 12 billion euros of capital, is in the hybrid issues, the deeply subordinated subordinated debt, which is rated by Fitch Ratings at the lowest level of investment grade. So, you know, we've got a fairly delicate situation at the moment, and really EDF needs to do what it can to try to stabilize the credit. I've got some frequently asked questions here, but I'll just leave those on the screen for a second before moving on to a summary and just a little reminder maybe of the main points we've tried to make this afternoon. So EDF is, I think, in its fairly substantial CCGT build, raising the risk of significant stranded assets as time goes on in the gas fleet. I think it's fair to say that the nuclear business is certainly crowding out capex on other businesses, particularly renewables. As we've seen, the balance sheet is seriously stretched with 64.5 billion of net debt, about 3.6 times EBITDA on EDF's guidance for this year. In terms of the transition plan, we think that the nuclear on existing nuclear can probably be funded, but for the rest, we've got some very substantial challenges going forward. And the last question really refers to the Paris alignment or whether or not EDF credit becomes high yield in future. And that's enough for now for my presentation. If I can pass over perhaps to if there are any questions, please.
Thank you very much indeed, Chris. We have a question that's come in from the audience, but before we tackle that question, I wanted to just ask very quickly on how does nationalization improve EDF Group's ability to generate free cash, as it was, I think it's a fairly important question here.
Yeah, so what nationalization does is it potentially, I think, gives the credit rating agencies scope to give a larger uplift to the cost of credit for EDF, which is potentially going to reduce debt costs. So that may be a positive with nationalization. But I do think that it's going to clearly narrow EDF's equity options. EDF had a capital increase last year, in fact, and has had capital increases over the past few years to try to bolster the balance sheet. So in many ways, that option has gone now. And I think that if what we probably need, the single most important thing we need for EDF to be able to generate free cash is to re-regulate the existing French nuclear fleet, which of course will be subject to, or re-regulate remuneration of French existing nuclear, subject to what the French government and EU Commission approve. It's also the case that in 2025, there's a reform of the ARENH price cap on output, which has to be sold to EDF's customers. That price cap is 42 euros and should be lifted. And that, again, may be another step in the right direction. And finally, one more point on the distribution business is that the capex on smart metering is due to finish fairly soon. And therefore, that business will start to generate some free cash flow as well. But clearly, there's a lot more to do. I'm just really giving a few small steps in that direction.
Interesting. So, with the cash in mind, I mean, how can EDF fund bigger renewables build in view of these cash demands of existing and potentially new nuclear?
The previous senior management team, headed up by Bernard Levy, this previous CEO, was looking at what was called Project Hercules, which was floated in the French circles for quite some time, up to about 6 or 9 months ago now. And what that was really aimed at was looking at splitting EDF into two, with the renewables business, the distribution business, split off from the generation business, nuclear, and potentially also hydro. And that would have allowed EDF, in the company's view, to increase its renewables target or target build for 2030 from 60 gigawatt to between 100 and 120. So there was potentially a route to a separate funding path for the renewables business at EDF. That's clearly gone now with nationalization. But I think that ultimately we have to look at these options again, if only because as things stand as we've seen at the moment, it's very hard for EDF as it's in its current form to increase capex on renewables.
Thank you, Chris. In slide 7, you mentioned that EDF is adding 5.5 gigawatts of new CCGT. Of course, the question is, why is EDF building this capacity with clear stranding risk?
So I think that EDF originally got into the gas business because it was seen as a flexible technology complementary to nuclear, which is fairly inflexible. And I think that additionally, the reason for buying Edison, which was the gas business, was also to diversify away from the French market to Italy as a way of balancing out French risk. What EDF says officially is that it will build CCGT if that's going to reduce carbon intensity, or if it's going to improve security of supply. And certainly the Italian government has, post-Ukraine, become much more keen on finding alternative sources of gas to Russia, because Russian gas is very important to Italy, or it used to be. So there's some politics in there as well. And that explains why 2 of the repowering projects are actually quite new at Edison. Nevertheless, I think that given if you take the view that these assets can only have a run for a 30-year life, I do think that there's a substantial risk of stranding as we get towards 2050.
Interesting. And we have a question here from Pierre Lenders, which is related to a statement you made earlier, where you said that water intensity is 4 times that of Enel. And the question is cooling nuclear plants is damaging or polluting?
I think that there are regulations, or there have been regulations in the past about temperatures in rivers for cooling nuclear turbines. And it's been harder and harder to meet those regulations, given what's happened to temperatures in Europe, for example, last summer, which has given constraints as to how far you can cool some of these turbines. So this is getting harder to address as time goes on. And it is certainly, an outstanding issue, I think, that, where more work needs to be done.
Yes, indeed. And actually, you're absolutely right. Last year, this made headlines in popular press, how EDF was struggling to take water out and put it back within regulations. I think I would like to turn my attention to a question regarding emissions reduction targets. Will EDF update its emissions reduction targets as a part of its new strategic plan?
I think the new CEO has his work cut out. He was only appointed at the end of November last year. And I think that given that, the figures we've seen already on the slides for 22 are ahead of the 23 targets, then clearly EDF has to come out with something new. We're already, nearly halfway through 23 already. So they have to do something, I think. But it would be a good opportunity for the new CEO to burnish his environmental credentials as he starts his new role.
We have another question coming in from, unfortunately, it's anonymous, but nonetheless, we shall ask it. And the question goes as this: as one of the primary sources of European CO2-free baseload power, is it not completely understandable that they are spending a significant percentage of capex shoring up the existing nuclear fleet and not focusing on new renewables, which is already a convoluted market? Contentious.
So I think that there's a lot to be said in the question. I think that it's fair to say that the French fuel mix is very heavily nuclear based, and there was on the previous government a plan to reduce French nuclear to 50% of the fuel mix. And I think that although there is certainly a case to be made for maintaining the existing fleet, I think that if we look at the numbers at the moment, and nuclear accounts for 76% of output, that is still a fairly unbalanced fuel mix. And I would suggest that if there were to be a little more room for renewables, particularly offshore wind, particularly solar in France, that would probably reduce some of the risks actually involved in holding EDF equity or debt.
Which is linked to one of your frequently asked questions, if I remember from your slide. Is there a better alternative than more nuclear?
I think that it's fair to say that there is a much stronger case for extending lifetimes of existing nuclear than to think about building new nuclear. If we think about security of supply, it's a much quicker solution in that sense. Of course, it has to be done safely, and the French nuclear authority is very keen on this being done so that the fleet, which I think is 37 years old now, can be safely extended to perhaps 50 years, maybe even 60 or even 60 plus. That probably, to me, is probably a cheaper and quicker route to resolving this issue than really thinking seriously yet about new nuclear.
So let's extend that thought a little bit, because as you well know, that all the buzz around nuclear, it seems to be focusing towards SMRs at the moment and their role in the energy transition. And with nuclear becoming more and more considered as a part of the solution, where do you see SMRs fit into the picture for France?
Okay, so the French government announced some state support for SMRs last year for 500 million euros for EDF to develop the NUARD program, which is for two 170 megawatt units, so 340 megawatts. And EDF is looking to harmonize the design of SMR with the regulator in France, but also with the counterparts for the regulator in Finland and the Czech Republic. And I think this is aimed at reducing the cost of SMR in particular. And EDF has actually set up a subsidiary late last year to lead the basic design of SMRs, hopefully with completion by the end of 26 and construction planned in 2030. However, I would guess that this is only a partial solution to the French fuel mix, because the entire French fleet at the moment is between 65 and 70 gigawatts, about 68. And I don't think that units of 340 megawatts are going to come anywhere near close to replacing the entire fleet. I don't think we're looking at in those terms. I think also it's fair to say that the French market traditionally has been very centralized with much larger scale units. You think about the size of Flamanville 3 or Hinkley Point being built now. Those, I think, are probably EDF's first response to new nuclear, and SMR perhaps as a secondary response.
Interesting. We have another question coming in from Pierre Landers. The question goes as follows: how much will the renationalization of EDF reduce its cost of servicing its debt in absolute percentage of EBITDA? And he goes on to say, I suppose it's quite an impressive number. Would that violate European state aid legislation? And he also says, thank you.
I don't have the numbers in front of me. I have to go away and think about that. Would you mind if we take that question offline?
Absolutely.
Come back to you.
Fantastic. Okay. I'm going to think about France in terms of how it's structured and its grid. And it goes back to your frequently asked questions. If we imagine a France where there's more and more renewables, the question is how suitable is the French grid for more renewables? Is there a threshold?
So the French grid, RTE, used to be part of EDF and recently issued a new spending plan, which runs from 21 till 2035. So probably shortly, it finishes shortly before new nuclear will probably be online. But that plan is really aimed at doing two things. The first is to double international interconnect capacity. particularly with those markets which have supplied France recently in view of its nuclear problems. So I'm thinking about countries like Germany, Spain. And that's also aimed at balancing out the peaks and troughs intraday, intra-week between those markets and other markets like Italy, UK, Switzerland, where France is actually exporting energy at the moment. That's one thing. So the interconnector is one thing. The second thing is that they're looking at additional work to support the grid for offshore wind, which for France is quite new and is just starting now. And that will be certainly a key area of development going forward.
Thank you. I have a question here which is related to Scope 3 emissions. What measures is EDF taking to reduce Scope 3 emissions, especially gas by the end customers?
That's a harder question to answer. What it has done is I think it sold one of its North American gas businesses a couple of years ago, and that helped numbers to a certain extent. And it's also fair to say that last year, because the gas price was so volatile, load factors for CCGT were lower, and therefore there was actually lower gas CO2 emissions. But that's probably a blip. I think that the question of Scope 3 is a difficult one because in many ways we're talking about carbon consumption by customers as opposed to carbon emissions from the producers. And I think it's probably going to be the case that in some cases, the cost of abating those emissions may fall on the customer or indirectly through the regulator or through government, as opposed to falling onto the company. And how that cost sharing works has yet to be seen. It'll be different in different jurisdictions and different markets. I think that all companies face this issue. ENGIE certainly faces this issue as well. And I think that the thinking in this has yet to be very developed. I think that the simplest way, as I said before, that EDF can solve this problem short term is to stop building CCGT and sell Edison, but that's very, I think the former is fairly unlikely. So we'll have to see. That we certainly want some more detail. Perhaps we'll get some at the strategic plan in June.
Interesting. I'm going to turn now to EDF's, I guess, work abroad, if you like. If I just share with you a thought, back in the days when the Soviet Union collapsed and Russia was one of the markets that Russia was well known for was its nuclear industry. It used its experience and its abroad in order to keep its nuclear industry alive. It had a number of contracts, including China, and it used that business to really keep its nuclear business on life support. And then the oil prices rose. It had revenue in order to build its own nuclear industry at home. So if we go to right before the war, Russia's nuclear power industry or nuclear export industry was somewhere around 230 billion. It had a huge amount of reactor projects around the world, something like 33, whether it is in planning to actual building. So you can sort of see how its foreign business played a big role in supporting its domestic business. How would EDF see that?
I think the European nuclear build has been a much bumpier process than it has been in Russia or China or even the US, with the impact of Chernobyl on the supply chain in Europe. It did to that. I think we talked before about SMR and how the French safety regulator is already talking to its Czech and Finnish counterparts about harmonizing design features, trying to reduce the cost. So there is certainly a amount of collaboration going on outside France. And I think also this has been covered quite extensively in the press, how the French government has been lobbying quite hard to get nuclear to be considered a sustainable technology for the purposes of EU taxonomy. And it does have some support from some of the Eastern European countries, specifically Poland, as well as the Czech Republic and Finland as well. And I think another point of this is to say that looking at French government policy, I think that the nuclear industry is an industry which the French government would love to see successful, not just in France, but in export markets as well. So there are some fairly concerted efforts to sell EPR2, for example, in India and other export markets as well. So, this is also part of a bigger picture, I think, for the French government, not just what EDF is trying to do.
Interesting. A question that Dan Jurgen used to always like asking me when I was presenting, and I'm going to throw it's a very straightforward question, but I think it's very useful from the financial institutions' point of view, is that if we were to put ourselves 10 years into the future, what do you think we'd be saying about EDF's energy transition then?
Well, I think it's, we've said that if you have a nuclear footprint, your carbon emissions level should be pretty low to start with, and therefore, in many respects, you're a hero compared with more fossil fuel based companies. However, as we've seen, the flip side with EDF is the gas business, and that, if anything, seems to be growing at the moment rather than shrinking. I think if we think 10 years out from now, I think that we will continue to need nuclear as a baseload fuel and as a low carbon fuel. And until renewables finds a commercial means of storage, which means that renewables can compete on baseload with nuclear, I think we have to live with nuclear. I think it has a role to play. And to that extent, the timeframes that we're looking at for nuclear, to build a nuclear plant will take 10 years from today anyway, probably longer. I don't think that the market context is going to be radically different from where we are today.
Thank you, Chris. We have another couple of questions which come in from Henrik Jefferson. So let me read them to you. First one, on nuclear, would it not be a strong long-term strategic direction by EDF as one of the most experienced nuclear operators in the world, and given that nuclear tech solutions take time to develop, to significantly increase its focus on developing new nuclear technology? Do what you are good at, to be installed in 2035 plus, when most fossil fuel capacity and lots of existing renewable capacity need to be retired and replaced, and to invest for growth?
I think the industrial case, the environmental case is quite sound. I think, as we've seen, the problem is that EDF is struggling to fund keeping its existing nuclear fleet running on its current cash flow projections. And therefore, we're going to have to find, according to the latest estimates, at least 52 billion to build 6 new EPRs. And that excludes another 8 that the French government would like to build. That excludes SMRs as well. So to turn the question around, we would need somebody who's prepared to fund that. Would the French taxpayer be prepared to fund that? Given what I've seen on the news about what's happening in Paris at the moment, maybe not. Maybe now's not the best time to ask the French taxpayers to stump up additional cash, and during a cost of living crisis. So I think the long-term case is a very good one, but I think short-term it's very difficult to find funders for that.
So broadly, where should its focus be, do you think? And in this question, including hydro and nuclear?
I think that even hydro is challenged in a way now that we thought unthinkable 5, 10, 15 years ago, because we've had drought to 2 years in a row in Italy. We had a serious drought in France last year. And therefore, the predictability of cash flows from hydro is not what it was. And that too might suggest a stronger case for alternative renewable technologies such as solar, such as wind. I think on nuclear, we've we've covered the main points already.
Very good. Another question's come in from Vincent Meyer. What would EDF's best strategy to reduce its stranding risk be? Remembering we were talking about the gas capacity. And here he throws in pre-funding, transferring to an insurance company or else.
So some of the capacity which is being built in Italy today has capacity market contracts. So that will help the funding profile for some of these projects. It's interesting to see that Edison in Italy also has now set up a joint venture, I think with Crédit Agricole, whereby there is, in renewables, where there is some funding support from other minority partners. And this might be a potential route to take in gas as well. Having said that, though, I think that the climate risk should be reflected in the cost of capital for gas in a way that wouldn't be the case for renewables. So the hurdle rate, I would suggest, may be higher for gas than for renewables.
Thank you, Chris. I think we've run out of questions at this point, and I have no further questions myself. Before I move to closing, oh, hang on, there is another question just come in at the last moment. Henrik again. Let me get this question as we have time. Is there any other real solution to help fix EDF's cash flow problems than it needs to raise rather than raise electricity prices?
Well, traditionally, the biggest source of EBITDA for EDF used to be generation, nuclear generation, because the fixed costs for generation are very low. And if you look at EDF's UK business and how that breaks out its earnings, it's the same story. By far and away, the biggest part of the earnings come from nuclear generation. Therefore, we would need a situation which protects generation from very volatile power prices, which we've seen over the last few years. And that would require some form of re-regulation, maybe a parallel market, perhaps. That would have to be subject to French government approval, but probably more likely EU Commission approval as well, and how that might work with state aid rules, for example. So it's far from simple to do that, but I think that's probably the shortest single route to protecting cash flow at EDF. The supply business traditionally has been a business which has never been very profitable, whether it's for EDF or for pretty much anybody else. It's not a very capital intensive business. It's got very low barriers to entry. So I don't necessarily see that as the biggest answer to EDF problems. And I think I mentioned earlier on the call that the smart metering rollout is almost complete now. So the cash flow profile from the distribution business should begin to improve. And as we've seen, that's a fairly big part of the group.
Thank you very much, Chris. I think now we have actually, we're actually reaching our target time. And I want to, unless any questions come in as I'm closing out, which I will take the opportunity to ask, I want to thank all those who asked questions. It's very, very helpful for the other participants as well. And feel free to continue asking us questions. After all, we're a think tank and we love questions and trying to answer them. I want to thank Chris Moore, who was never stuck and has produced a wonderful piece of research, which I would urge everyone to download from our website. So thank you, Chris. I also want to thank Kerry and Evgenia, who put together this webinar, and also and everyone who joined us, and please join us again for future webinars. The next webinar on the cycle is a webinar on Shell, which is on the 10th of May, 3 o'clock. I look forward to you joining us on that session. Thank you very much indeed.